Risk 5. Debt finance and WACC. Thus far, investors have been limited to equity shareholders. Now let's consider debt holders. Let's assume CAPM tells us that the shareholders' required return is 15% for a particular firm. So the cost of capital for this firm is 15%. Though the firm has so far been financed only with the shareholders' own equity, one day they start to think about getting rich using someone else's money. The managers agree and point out that the firm can borrow half the investment money at 10% per year. In this situation, there are two questions. Why do debt holders accept a return of only 10%, though the firm's cost of capital is 15%? Will debt holders' participation decrease the cost of capital for this project? The answer to the first question is that debt holders take no risk. They will get their 10% return without fail. This is one aspect of the risk-return trade-off. To answer the second question, our conclusion is that a firm's capital structure, meaning how the firm is financed, is irrelevant to the firm's value in a capital market. This is because, as debt holders come in, the risk to the firm increases, so the shareholders' required return increases with the increase in risk. The relatively lower interest rate required by debt holders is cancelled out by the increase in the required return of shareholders. When debt holders come in, the total cost of capital can be expressed as the weighted average of the cost of capital. The equation looks like this. Here, RE represents the required return of equity, RD represents the required return of debt, L represents market value proportion of debt financing, and T represents the marginal corporate tax rate on income from the project. WACC is a calculation of a firm's cost of capital in which each category of capital is proportionally weighted. Note again that a project's value is not affected by how it is financed. So, WACC is a constant for all values of L. As more and more debt holders come in, the risk of the firm increases. So, the shareholders' expected return increases with the increase of risk. WACC tells us how much the new shareholders' required return is. That means that just by plugging in the market proportion of equity and debt, and the debt holders' required return, we can calculate the increased expected return for shareholders. For the above project, the new return to shareholders is 24%. Or, if the shareholders' required return when the firm is all equity financed is unknown, we can just plug in each component of the formula from market data and find the required return for the project or the company. So, if Fast Retailing's required return for equity, RE, is 10%, and its required return for debt, RD, is 8%, its debt-to-total value ratio is 40%, and its marginal tax rate, T, is 40%. Fast Retailing's WACC can be calculated at 7.92%.